Hey everyone, welcome back to Lazyboy Crypto. I made a video recently about real yields in DeFi and how some platforms, they don't show you a real yield. They basically just show you either a high APY or a projected yield, which is kind of off base and not very realistic. But there is one project that I mentioned that actually shows you the real yields, and that project is Polysynth. So I'm going to look at it in more detail today and show you what it's all about. Now, Polysynth, it's based on the Ethereum network, and you can basically just deposit your assets and earn real yields simply. You don't actually really have to do anything. You can deposit and withdraw whenever you like, or you can leave your funds in there and let it auto compound. And there are basically three ways that you can earn with Polysynth: structured products, yielding stables, and yielding cryptos. But each one is different. Now, if you've ever traded on the stock market, then there is something called covered call and covered put options. Now, this can be a little complicated to understand, especially if you've never used them before, but I'll try my best to give you an overview of what they mean. So Polysynth basically utilizes covered call and covered put options to generate real yields. And that's the thing with stocks or cryptocurrency, you can still earn money whether the asset goes up or down. So let's look at the yielding stables first. Basically, you can deposit USDC into either of these vaults. There are three of them: the BTC, ETH, and the Matic vaults. Now, these vaults, they generate income by collecting premiums on put options. Now, this is all done via smart contracts, so it's all automated. It means that you don't have to do anything yourself. You just deposit your funds and you let the platform, the smart contracts, take care of everything. So this is bringing options contracts to the cryptocurrency market in an automated way. So the vault generates income by collecting premiums on put options sold. So normally with put contracts, it gives the holder of the contract the right to sell the asset at the strike price. When the asset reaches the strike price, which is a price determined within the contract, when it reaches that price, then the contract is in the money. And it gives the buyer of the contract the right to sell that asset at the strike price, even if the price of the asset is actually lower than that on the market. Because Polysynth is selling these covered put options, they don't want the price of the asset to reach the strike price, because then that means the contract is in the money, and that makes money for the buyer, not the seller. Because the seller of the contract is obligated to buy the asset if the contract is in the money and the buyer wants to exercise the option. So this is why the seller, Polysynth, doesn't want the contract to be in the money. They don't want to have to meet that obligation. Regardless of what happens, Polysynth does get to keep the premium paid for the contract. But also, Polysynth only deals with contracts that have a 1 week expiry. So this mitigates the risk somewhat, because if there's only 1 week, what are the chances that there's going to be big swings in the price of the asset in just 1 week? It's actually pretty low. And it's the same with the covered call options. The seller of the contract is obligated to sell the asset at the strike price if the buyer exercises their option. But again, they only deal with 1 week expiries, so there shouldn't be huge mooning opportunities of the asset within 1 week. And of course, the seller of the contract, Polysynth, they get to keep the premium for the contract sold anyway. So when it comes to these vaults, the yielding stables vault, this is when Polysynth is selling the covered put options. So basically, this is good for investors who don't think the price of the asset is going to fall below the strike price. So if you're moderately bullish or neutral on an asset, then this might be something that you want to look into. And the yielding cryptos is for the opposite. So this is where they sell covered call options. Polysynth is making money by selling these covered calls, so these yielding crypto vaults are good for people who are neutral on the asset, moderately bullish, or bearish. They don't think the price of the asset is going to rise that much, at least not above the strike price. Now, even though this sounds complicated, you don't actually really need to know any of that, because all of this is automated. The vault earns yield on its Bitcoin deposits by running a weekly automated Bitcoin covered call strategy where it sells out of the money call options and generates yield by earning options premium. It's essentially all you need to know. And because it's all automated, all you have to do is deposit, and then you can watch your funds grow, and you can leave them in there and they will auto compound. And then finally, there are these structured products. So let's click on these. There are two of them right now. There's the 90% price drop protection and the 50% price drop protection. Now, this one is slightly riskier, hence the 30% APY compared to just 11% APY for this one. So let's just take a look and I can show you what it is. It's basically a packaged product of various ways of generating yield. But it has something called a knock-in and a knock-out price. So 10% is the knock-in and a knock-out is 130%. But let me explain this to you. So, similar to bonds, the strategy pays a fixed predetermined yield called a coupon on a daily basis and returns your principal, the amount that you invested, at the expiry date or maturity date of the vault. Now, in their white paper, they go over some scenarios on how much you can earn depending on the situation. And there are many potential situations that could happen with these structured products. I'm not going to read all of this because there's a lot to take in and you should really read it for yourself. But essentially, you deposit money into this vault and the price of the asset at the time that you make your deposit is 100%. So in this vault, the underlying assets are Ethereum and Bitcoin. So let's just say when you make your deposit, the price of Bitcoin is $20,000 and the price of Ethereum is $1,500. Okay, that's the 100%. And then there is an expiry for the vault. Now at the expiry date, if the price of Bitcoin is at or above $20,000 and the price of Ethereum is at or above $1,500, the spot is closing above 100%, right? Which means that you will get your full investment back plus a coupon, i.e. some yield, and here is some calculation on that for what you might receive. And it's the same situation even if the prices close below 100%. So this vault in particular has a 90% price drop protection. That means that the knock-in price is 10%. So as long as the price of Bitcoin and the price of Ethereum does not fall below 90% of its worth at the time that you made your deposit, then you will get your full investment back. The price of Ethereum or Bitcoin goes above the knockout price, which in this example is 130%, which is 30% above the price it was when you deposited, then the vault automatically expires. You will receive your principal plus yield. But if there is a knock-in event, then you may lose some of your initial principal. Now in the vault I showed you, the knock-in was 10%. That means that the price of Bitcoin or Ethereum has to drop at least 90% in order for the knock-in to be reached. And if it does, on even just one of the assets, then you could lose some of your principal. Because this vault has experienced a knock-in event during its lifetime, the principal returned when the vault expires is calculated using a formula based on the worst performing asset on the final day. But with this vault, you're basically saying as long as the price of Bitcoin or Ethereum does not fall below 90% of its current value, then you're going to be earning some yield. And in the case of this vault, this one contains Polygon as well as Ethereum and Bitcoin. So there's 3 assets in this vault. But with this one, it's slightly riskier because you're basically saying as long as the assets do not fall below 50% of their current price, then you're going to be earning some yield and you will get your principal investment back. So there is more potential for higher gains with this vault, but obviously it's a lot more likely that an asset will fall 50% than it is to fall 90%. And so that's why this vault is slightly riskier. But you know, the vault's success rate is 100%. That means that each time period that this vault has been running has been successful and profitable. So if you're moderately bullish on either Bitcoin, Ethereum, or Polygon, then these structured products might be something that you want to look at. Because if you're saying that you really don't think that they're going to fall by either 50% or 90%, then you're in good standing to actually generate some yield with these vaults. But remember, all of these strategies are fully automated. They're run by smart contracts. So all you have to do is deposit and then decide when you want to withdraw. And remember, you can just leave your funds in there and so that they will auto compound. So that is Polysynth. Let me know what you think in the comments below. Will you be trying out any of these option strategies? It is really awesome that they are bringing automated option strategies to DeFi. It means that you don't actually have to have all of that knowledge about how to trade options. Instead, you can just let the platform and the smart contracts do it all for you. And of course, I like that Polysynth just shows you the real yields as well. There are no false promises with Polysynth. It's all laid out in black and white. So anyway, thanks for watching, and if you enjoyed this video, then please give it a like and don't forget to subscribe. Thanks for watching.